Prediction markets are flashing a warning sign ahead of this week's US jobs report, and Wall Street is paying attention. Traders on a leading prediction market platform have positioned themselves for a disappointing number. Specifically, they are betting the monthly jobs report will come in below the consensus forecast tracked by Wall Street economists. That is not a guarantee of anything. But when real money moves in one direction, it is worth understanding what it means and why it matters. Prediction markets are different from surveys or polls. Participants put actual money behind their views. The prices that emerge reflect a collective judgment about how likely a given outcome is. When those prices tilt toward a miss, meaning a number that falls short of expectations, that signal carries more weight than a simple opinion. The report itself is formally called the Employment Situation Summary, published by the Bureau of Labor Statistics. It drops every month and covers three key figures: payroll growth, the unemployment rate, and average hourly earnings. Of all the economic data released on a regular basis, this one moves markets as fast as almost anything else. Stocks, treasury yields, and Fed rate expectations can all shift sharply within minutes of the release. That Fed connection is especially important right now. The Federal Reserve is currently weighing whether to cut interest rates, hold them steady, or simply keep its options open. It has held rates at elevated levels to cool inflation. But if the labor market is softening, if hiring is slowing, and the economy is losing momentum, the case for rate cuts gets stronger. A weak jobs number would add to that pressure. Here is what a miss could look like in markets. Treasury yields would likely fall, since lower yields reflect expectations of easier monetary policy ahead. The dollar could weaken, and equity sectors that benefit most from lower borrowing costs, think rate-sensitive areas like real estate and utilities, could see a lift. Now, one data point rarely tells the whole story. Job growth can surprise in either direction. The report's methodology is complex enough that a month of solid underlying hiring can still produce a soft headline figure, and the reverse is also true. The consensus forecast itself carries a margin of error. What matters most this week is not just the raw number, it is how far that number lands from what markets are already pricing in. A miss confirms the prediction market signal, a beat scrambles it entirely. Watch the gap between the actual print and the forecast. That gap is where the real market reaction lives. This briefing is brought to you by First Financial News, Clear. Daily coverage of the economy and markets at firstfinancialnews.com.